participants and Ms. Seema Chaturvedi, who is our guest speaker for the evening today. And the webinar topic for today is effective fundraising strategies by AWE Fund. Seema, can you put on your
Yes, sorry, but one sec.
Yeah, sure. Sure.
Yeah, no, go ahead, go ahead.
Sure. So just to introduce the participants and Ms. Seema about MSINS. So Maharashtra State Innovation Society is the state's nodal agency to spur innovation and promote entrepreneurship in the state. We have been established under the Skill Development and Entrepreneurship Department of Maharashtra government. We run various initiatives as envisaged in our Maharashtra Startup State Policy 2018. To name a few, we have the Maharashtra Startup Week, which is our flagship event, wherein 24 startups are given a work order worth 15 lakhs to pilot their project with the government. We have also initiated establishment of 16 incubation centers across the state, and latest addition being the SNDT Women's University Incubation Center. Recently, we launched 2 schemes of providing direct financial assistance to the startups for intellectual property rights support and quality testing and certification support. Please visit our website www.msins.in for more details. And if you are fit to apply, do avail these benefits. We have also successfully implemented Hirkani Maharashtra Chi to support rural innovation and also conducted a Maharashtra Startup Yatra in collaboration with Startup India. Apart from these, we have several activities lined up for the coming year. So I request you to keep checking our social media handles for regular updates. To introduce our guest for the day, Ms. Seema Chaturvedi. She is the founder and managing partner for AWE, which is Achieving Women Equity Funds. She has 20 plus years of experience in capital markets and financial management. She has been an entrepreneur, an investment banker, and an investor. Thus, she brings a unique perspective to the strategic planning and investment process. Just a brief introduction about the AWE Fund. AWE Fund aims to invest in innovative enterprises which positively impact gender balance by investing in women-owned, led, and influenced companies in India, building on investment theses that investing in women businesses deliver both commercial returns and social economic development impact. AWE Fund is an early growth fund and is a sector agnostic, but primarily focuses on tech-enabled companies in food and agri, health, education, sustainability, primarily being clean tech and water, and fintech sectors. So, AW Fund, apart from this, it's an early growth stage fund, and they generally provide pre-series to Series A with their sector-specific expertise and additional operational expertise to investee companies. So to begin this session, Seema, I welcome you on board again for this session today.
Absolutely. Thank you so much, Ruchi. And thank you so much, Devender. A real pleasure to be here.
Thank you, Seema.
And good evening to all the participants.
Thanks, Seema. So should we begin the session now, Seema?
Absolutely.
Yeah. So to begin with, I'll request you to please tell us about yourself and your journey as a woman entrepreneur. What inspired you to take such a difficult role as all of us feel, being a woman entrepreneur, breaking the glass ceiling and moving ahead?
Thank you so much. And Ruchi, if it is okay with you and Devender, I'll most definitely begin with that. I put together a few slides just
Sure,
to
sure.
speak specifically about the effective strategies. And then more than happy to make this a highly interactive session. Folks, please feel free to ask questions. Ruchi, if you can keep an eye on the
Sure.
chat or Q&A.
Yes. So I request all the participants to post in your questions in the chat box, and we'll be happy to answer that post the session is over with Seema.
Absolutely. Is there a way for us to understand where everybody is at? Like, how many of you are entrepreneurs? Could you give us a sense on writing in the chat, whether you're an entrepreneur, male or female? This session applies to both, so it'll be great. I see a few wall poshers coming through. Thanks so much for letting us know. Is this so? No, Ajit. Fundraising is for everyone. We all need money. Uh, this session, we do want to focus on helping women, but no, Amravati, Maharashtra. So that's great. I'm assuming most of you are from Maharashtra. But having said that, given the good work that MSINS does, I wouldn't be surprised if some of you are from outside state. But um, okay, this is very helpful. Tech development. So is it fair to say that, okay, so you do have healthcare, fairly diverse sectors. That was going to be my next question. If you give me a flavor of what sectors you're from, I can help. I can try to make it more contextual. So if a few of you can give me a sense of what you're into. Oh, you're from Chennai. Look at that, Aarti. Thank you for joining us. Engineering services. Rashmi, is that Dharwad or anywhere closer? Okay, you're Mumbai. There's a pretty significant engineering services belt in Dharwad. So a lot of services, tech, healthcare. Great to see that. All right, that's very helpful because a lot of this is extremely relevant. Construction, I haven't done much, but I'll start off now with telling you a little about us, about my journey. So my journey is a journey that has taken me across continents to multiple different countries, primarily based on um, a career that I built in finance. And my journey is of a person who actually did live in Maharashtra as well, because we traveled quite a bit as I was growing up. But I began my career in India, and we were one of the early teams to be changing the face of, I'd like to say, the face of corporate capital markets in India, because we were actively engaged in SEBI. So not to date myself entirely, but SEBI had just been set up, and we were one of the pioneers to be shaping the public markets through and the capital allocation through the IPOs and the rights issues and the bonus issues that were coming out in the market. And we did we did handle some of the leading uh, India's leading public issues at the time. I've also been then, after having completed my master's in the US, have worked in wealth management side, where we were investing people's money in different asset classes, and then we moved on. I moved on to um, essentially doing a lot of work in helping companies sell to realize shareholder value for primarily the promoters. And then I switched that and started investing. And so I've been investing, and I found that very fascinating because that's kind of where you're setting strategy and you're thinking like a promoter, in which also actually prompted me and coincided with my switch over to becoming an entrepreneur. So way back, I did that. And going forward, what I'm going to focus on is are lessons that I've learned, not just as a professional, uh, in raising money and investing money, in getting exits for our investments, but also as an entrepreneur, which I think is a very valuable set. And I often joke with my prior bosses saying, what I hadn't learned in 7-10 years, I learned in the first 3 months, because the pressures of payroll are so real that you have to find whatever it takes to meet that payroll, and you better have some solutions, and the overheads get real. So we are, as of funds, Ruchi talked about us focusing on wanting to invest in innovative enterprises that promote gender equity. So it's really bringing 25 plus years of investing for helping companies that are not all so owned, led, or influenced, is what we say. They don't all have to be owned or led by women. It'll be great if they are. But what we're trying to do is promote a gender equitable world. And we think there are multiple ways to do that. But using the lever of capital allocation, we can accelerate what will otherwise take 208 years. Unfortunately, I'll be long gone. not to be sordid about it, but I'm in a bit of a rush, and I'd like to see that accelerate for our kids and our grandkids and their kids. So we're doing our part, and one key lever, as I said, is equity, and that is where I strongly think there's a big gap in terms of um, helping enterprises. And Ruchi, I'm going to have to request you to enable my screen share.
Sure, Seema, we'll do that.
Sure. And as you do that, what I'm going to talk with all of you today about is an encapsulation and a summary of what I've seen over the years, what works and what doesn't. And every aspect itself builds upon you'll, as hopefully you'll tell, builds upon years and years of experience of having done this, and I've tried to bottle that message in a small set of slides. I'm hoping you can all see my slideshow.
Yes, Seema, it's
Oh,
visible.
okay. Sorry. Right here. So I want to begin with this for everybody. Again, a show of hands. Is there anybody on this call who is already venture funded? If just quick yes, no, or are they really early stage? Uh, and Ruchi, if you have a sense, let me know. Are they really early stage? Have they raised venture funding?
So the data we have, Seema, is more on the really early stage, and a couple of
Okay,
them, as this Komal startup has been funded by BIRAC under DBT.
great.
Yeah.
Okay, all right. So essentially, let me start with this. Some of it may be repetitive, but it helps set context. So, folks, and you can think of this as your own money. If the higher the risk, higher the reward, right? And so this kind of gives you an instructive where to look for money. I'm going to blend in aspects also about specifically women entrepreneurs as I think relevant, but essentially I want to repeat this applies to everybody. You need to know risk and reward correlations. So debt is on the low end of the X and the Y because it's an obligation. You've accepted that you will pay back somebody. You've taken money and you've put in a legal contract that you will pay it back. In some cases, and that's typically senior debt, where you have literally given a lot of your collateral as backup for your commitment. And sub debt typically is unsecured, where you've not given collateral. So it's a little risky to the investor because if the company or the entrepreneur doesn't deliver, they really can't chase much. Uh, but other than legal contractual rights, and then there is the pecking order thesis that kicks in, so they can recover their money before the equity guys. So by definition, equity guys are this is the world of equity on the right side. These are the people who essentially will be taking the most risk. Now, equity, you got to understand, isn't just one type of equity. It comes in different colors, different complexions, and you need to know specific to your stage where you want to go look for money. So the first thing I'll tell you is figure out which world do you belong in. You cannot, and it's important to know that because it really helps when you're talking to investors, and especially if you start getting into institutional investor world, nobody they just expect you to have finished and done your homework. You can't just show up as at an angel stage expecting a private equity guy to invest. I mean, first chances are you won't get the meeting, but if you for some reason do, it's just going to say, well, the person didn't even take the time to study and he's or she's just showing up without homework. It's a small big world. You people talk to each other. You don't want to be known in the market as somebody who doesn't take the effort to do their homework. It doesn't help. So what's really the difference? It's really a function of the stage of enterprise that you're going to when you're um, seeking funding. So an angel group is somebody who is essentially right after your friends and family around, and they take the high because your company, chances are, has not even gone to MVP, doesn't have a fully established product market fit, or maybe even ideation phase or a little idea after ideation phase, doesn't, most definitely doesn't have revenue. And so they're taking the highest risk and therefore they expect the highest return. That's fair. Um, what what next happens is you start getting more institutionalized. And again, within VC itself, there's a big bucket. So it's not just one lump. It's like early stage, mid stage, late stage VC. Again, but it's a universe where they are venture and they are more, they have more of a risk appetite, which is reflected in the number of deals that they do, because the expectation there is that they might end up not hitting a sixer, effectively, to use a cricket term, with every investment that they make. And so that is the expect that. So in that manner, they expect a higher risk. Private equity is when a company has been institutionalized and there is a very strong team around you to execute. And at this stage, you're getting really sophisticated late stage investors. So from angel down to private equity, you are kind of increasing in check size and decreasing in um, the level of, or maybe it put it another way, or you're also increasing in your age of the company or where it belongs in the life cycle of the enterprise growth. Is that fair? I do want to emphasize, and this is a slight bit dated, but you should check into one, putting this aside. There, I didn't mention grants, but grants are non-dilutive, so you're not giving any equity away, but and you're also not taking any obligation to pay back. Most of the grants are non-repayable, but these grants are on the backs of philanthropy, so they would technically be, well, the risk to the investor is low because the investors pretty much said, I don't really care if you pay me back or not. And so you've got to, these are extremely, as you would expect, very, very competitive, uh, very, very competitive set of capital to come by. And you have to have an aligned mission to who the grant maker is in terms of what they're trying to promote. But I share these schemes because um, post-COVID, there were a lot of schemes that came up specifically that you should look at in terms of waiving off collateral or the freeing up working capital limits. So there's a lot of that that happens. Now, so you should look into it. I'm surprised by how often people don't even bother doing that. And sometimes there is essentially very low cost capital that is available, but nobody takes the time to bother writing for it. I'm going to transition now to equity, which is the topic for today, predominantly, at least based on what I'm speaking on. And I want to start with just the overarching equity versus equality issue because that's very relevant to all funds. And since somebody asked, is this for women? Well, to the extent we are highlighting this, and I think the picture says it. Picture's worth 1,000 words. So you can see what we are trying to accomplish is this on the right side as achieving women equity funds, because we think that that's kind of where the opportunity set is not made available and accessible. So we're not chasing equality, we're chasing equity. So we are overachievers and we want to perform at a very different level to be able to deliver the same access to opportunities that normally has been made available to to men and men owned led influence businesses, I guess is the right way to say it. All right, so let me transition now to real stuff. So what do investors look for? uh, I can't emphasize the need of the team. It is great to have a star visionary, but there's so many ideas. Ideas are excessively available, and some of them are extremely good. But unfortunately, they need us to have execution. And the execution comes through a team. And it's very, very important for you to identify a right set of team members. We also get the fact that as a startup, you may not be able to essentially find or retain the right kind of team members. Um, I would ask every one of you to, if you're not already familiar with the concept of ESOPs, read up, talk to people, they're compensation experts um, who can tell you how to structure an ESOP uh, or find ways to structure equity for founding team members, but get team members that are willing to join for converting your vision into reality, because that's something that we look for very closely. As I said in the chart before, the we want to generate returns if we are taking risks. And how do we, despite everything that every investor will tell you and beat their chest and say, oh, we take risks and blah blah, the fundamental nature of a person investing money is to decrease the risk uh, for themselves or their investors if they're fund managers. So in our case, we will be trying to find ways to decrease the risk. And how do we do that? Fundamentally, defensible business ideas. You've got to find a way to create a moat around your business. It could be in the form of intellectual property, um, copyrights, patents. But the stronger the defensibility, the increase in the value, the higher the valuation. If you are just running kind of a run of the mill operation, there's nothing wrong with it, but how easily repeatable is that by the next person? So start focusing on creating defensibility around your idea. Scalability, I want to emphasize this: not every business needs outside funding, and I say this all the time. Revenue is a great source, is a good source of cash, and profits is an even better source of cash. So when you've lived through enough economic cycles, as I have, you know that there's always a bubble, and then that bubble bursts. And unfortunately, when the music stops, it's very ugly. And you don't want to be an investor in a situation where you have essentially not been able to capture the growth of the company in a manner that gets you an exit. And this is, unfortunately, India has gotten a very bad rap, a very bad reputation by LPs, which are limited partners in funds, and international investors, who say that outside of the three, four, five big names, they have not gotten an exit. And I want to emphasize this again for people. I am in the business of making money for my investors. You might be in the business of selling a healthcare service. I'm in the business of selling access to capital. And and I and I'll talk about this in a little bit even more, but right here I'll say help us de-risk to the extent possible. And one of the biggest signals of de-risking for us actively is using capital for your intended users. I cannot begin to tell you how many stories I have of where the money was raised and never ever used for that intended purpose. And these are big names with really, really big balance sheets who unfortunately saw that as free cash. And what they forget is, and I can see, well, I don't agree or see why they would say that, because to my point earlier, we are in the business of investing money. But the whole idea that equity is the last guy to get, or the last woman to get money out of the promoter because you have debt, sub debt, looking back at the chart I showed you, there was an attitude of, yeah, we'll get to them when we want to, as opposed to, I really need to make an exit for my investors. And what that did was there was a culture created of saying, I've raised all this money, now let me become an investor Well, somebody's put money into you. So first, please execute. And I say this to all of you know this as entrepreneurs. This whole concept that I'm an entrepreneur, I don't have a boss, I think is at best naive, because you always have a boss. You will always have a boss, and your boss is going to be a customer. And if you think you don't have a boss, well, it doesn't work that way. So, with everything I've said, all points to the need for demonstrating that the capital is going to be used for the business. All right, so how can you add value for your business? So, one big life lesson is you always say that this is not just about money, but specifically for money. You seek money when you don't really need it because it eases off the pressure in terms of how and where you want it. As I said, de-risk for the investor. We talked about creating intellectual property. I can't emphasize the need for corporate governance, and this connects to my point I made earlier. Um, Reflecting high integrity and transparency gives a lot of comfort to the investor. They may seem very simplistic, but they are so difficult to find, and you can build your entire career, entire life trying to uh, show to the world that you are a high integrity person, but it can get wiped away. So, what your mother used to say when you were growing up, listen to her, focus on integrity, and communicate that high integrity with corporate governance. Companies which have high corporate governance standards actually get a premium on their on their valuation. uh, Building on which, if you have a company which is less person dependent, because there is, especially in India, there is a churn, there is people leave, make it as process dependent as you can. By doing that, you're also improving the scalability of your business. So you are essentially doing yourself a favor of being less beholden to the whims of a person who may up and leave for whatever reason that's outside your control. And this is not the last point is not a favorite for a lot of startups, but I do come from of the vantage point of having seen multiple cycles and have seen how how companies can literally disappear. And to the point I made earlier, there's no shame in trying to say I'm trying to be profitable. It is it is okay to actually want to earn money because you set up the whole business for ultimately making money, and the best way to sustain that growth is to deliver a profitable business. All right, so fundraising process. I'm going to pause here and see are there any questions because I've been talking quite a bit. I want to make sure I'm not missing out on anything and keep this highly interactive. So Ruchi, do you see any people asking questions, comments?
Seema, there are no questions immediately, but we have received certain questions while the participants have registered, and I've kept it for you once you are done with your presentation.
Got it. Okay. Folks, I gotta emphasize now. Feel free to ask questions. It just will make this more fun for you versus just listening to me. All right. So let me get into the process itself. Emphasize getting your house in order. It's like inviting any guest to your home. You want to get your house in order in a manner that you come across looking like you've got your act together. That again builds a lot of confidence for the investor into your operations. I talked about finding investors who are stage appropriate. Don't go to a private equity person if you are in an idea phase company. And the same token, I don't ever expect you to go to a VC when you are a private equity because you've lived through multiple cycles of growth and you probably have advisors around you. Speaking of which, please do yourself a favor of getting legit, good quality legal advisors and counsel. Very worth every little pesa you spend on them if you get the right ones. The one thing I want to emphasize is look at their experience set. I'm not against giving the fresh, the newcomers a chance because they're also entrepreneurs, but do understand if they have a pulse, a finger on the pulse of the market, because uh, again, Nobody will tell you this, but essentially, if you have somebody who's getting billed by the hour, and they don't have a sense of what the market is for a particular term, because you'll have to actively negotiate, you're essentially ending up teaching them what market standards are for that particular term or clause, and that can become extremely expensive, especially if you're paying them by the hour. Yeah. And it also lengthens out your negotiation because you keep thinking, oh, I have to push back on this part of the term, and you realize uh, the investor looks at you and says, he or she is totally clueless. Why am I wasting my time? Let them grow up a little and come back to me. And you could have saved yourself all that grief by having experienced advisors. Specifically for women, understand, for the ladies on the call, understand your equity position. I am so surprised by the number of women, and I've actually led a program which we got funding from the US State Department to help promote women entrepreneurs. So back in 2015, 16, when nobody was really talking about as much about women entrepreneurs or empowering women, we'd like to think we started a movement. So it was a project we did in India, which helped women from 20 states, and they came from small towns, 106 small towns specifically. I was amazed by, and I don't say this in arrogance. I just say that in terms of surprise, to say the concept of equity was totally foreign in terms of the ownership. And when you would ask your, so all the ladies here, it's okay for you to know what you own in the company, and that's reflected in the cap table. It is okay for you to, if you're a co-founder, to have that discussion with your uh, founder and say, let's put this down in, um, in an agreement. It doesn't have to be a fancy agreement, but just make sure you know what your equity position is on the cap table. Because I've seen women who've had great ideas, uh, and that entire idea being stolen from them by their co-founders in some case, or by their investors, because they didn't pay attention to equity. Also, I tell them, if you can run a house on a budget, you can run a business and you can scale up the business. Because if you pause and think, there's a finite budget that is given to you, and you do whatever you can to stretch that for your family. You really, really stretch that rupee. And if you can do 10 things with that rupee, you're built for it. I can't find a better profession in terms of being the finance person. So you have inherent in you, even without any degree, you have the natural intelligence to be able to handle this yourself. Educate yourself. You know, it's not rocket science. It's very simple. Every business has to have revenue. To earn that revenue, you have to have expenses. Revenue minus expenses is profits. It's as simple as that. There's no rocket science. So uh, educate yourself, and actually stay tuned for an announcement that'll come from our funds on this. So yeah, and feel free to write to me. I'll have my email at the end. Educate yourself. We talked about that. Be persistent. I'm fundraising myself, and it's not easy. And this is after I've spent 20 years making money, investing money, getting exits for investors. You got to be persistent. Um, and also ask yourself if the business even needs venture funding. There are other, as I've talked about, other ways of getting funding. And then ask your investors, what else do you bring to the table? I will state this. I put that bullet down, but the reality is investors do have connects. And can they help you open doors? Can they help you with the networks? We are usually networked with other investors, and we can help you prepare for your next round of funding, or we can open markets for you. For example, our fund very strongly has an ability to get you strategic partners from India and US. We pride ourselves on helping companies have global ambition. because we've done that in the past and we've helped companies tap into international growth opportunities. All right. So my last kind of topic here is a relevant thing that you should know is how to value your own business. And there are really three broad approaches. So there's the asset approach, the what's called the income approach, and what the market approach. Without going into years of finance, I just want you to know of it. Um, I'll start with the market approach. Essentially, it is everything has a multiple, right? And again, going back to just uh, even if you were to boil it down, and I don't mean to demystify it to such an extent that you think it's useless, but think of it as everything has a multiple of what it trades at. You just figure out what your competitive set is and what is it trading at. Usually, for private equity, the level of funding, they trade at a multiple of EBITDA or earning before interest, tax, depreciation, and amortization. As you get to a more earlier stage, you move up the graph, people start talking about multiples of revenue. The one thing I've never understood is multiples of GMV. I've actually written articles on it, which befuddles my mind because sometimes people are not even earning revenue. I mean, they just literally money is passing through their bank account, and people want to get credit for it. And like I said, I've lived through economic cycles, and I know those eyeballs don't last. So at our funds, we are very, very particular about making sure that the company is at least earning revenue. But not every investor is like us. So find the right investor if you're not earning revenue and you still want to get funded. There are many investors who back in that. But then you better have a very scalable, quickly scalable, defensible business. Um, on the income approach, it's typically discounted cash flow of called DCF, and DCF essentially projects out the cash flow that your business is going to earn, and then discounts it using what's called a weighted average cost of capital or a WACC. Again, I'm just planting seeds. I don't expect this to be a full-on finance session, but take these terms and you can study it yourself. Asset approach is really used to understand what is the fair market value of your assets, a net of liabilities, and what is the value of the company. So those are generally the ways um, to know this in terms of knowing some terms. As I always say, a term sheet or an investment is not just the value you're getting, it's also the associated terms. So get to know legal terms. There's enough resources and more, and we are happy to understand, share some of this with you, including the presentation. So you need to know what an enterprise value is. You need to know what kind of funding you're getting, kind of like the graph I spoke about, the amount of equity that you'll be selling in the business. And you need to understand the concept of the term sheet typically is non-binding, definitive agreements are binding, the class of shares you're creating, liquidation preference. It's a function of, again, the nature of the investor. Venture funds typically want a participating liquidation versus, I'm getting into the weeds here, I'm getting more detailed here. But essentially, suffice to say that there are a set of 25, 30 terms typically in any definitive agreements. Read up about it and educate yourself. So hopefully I've at least planted some seeds with my presentation. And I'm gonna just pause here and stop sharing my screen, and happy to have a conversation.
Thanks, Seema, for the session. So we have received a multiple questions. So I just open the forum for you now. One of the questions is, how do you decide on valuation of a startup where it is only at a conceptual stage, but investors love the idea? How much equity is parted with how much investment? And is there any benchmark which, as an investor, you set aside?
So like I said, if it's an ideation phase, it's operating in a bit of a gray area. And what a lot of investors have started doing is the nature of investment tools that are available are the instruments. So you have the typical Y Combinator made popular SAFE instrument, which is essentially a security agreement for future equity, where they're saying, look, neither one of us is intelligent enough to figure out what the true value of the company is. We'll just come in and we will agree to give you a little bit of money, which is called a non-prize round. So a SAFE is a non-prize instrument, which means that nobody's really assigning a value to the company, but you get the money in and you say the promise is that in the next round, when the company does have traction, revenue, etc., and can be essentially use the traditional tools of valuation, which are acceptable to most people around that discussion table. In that scenario, they come in at a discount. So, for example, as a safe, I would say, I'll pay you 5 lakhs, I'll invest in your company 5 lakhs or 7 lakhs or 10 lakhs. And neither of us are smart enough to know what the value is. So let's just accept that next round, when the next investor comes, I'll get a 20% discount to what that person is investing in. So that is an increasingly popular instrument that most people are using at that ideation phase. If your investors are not willing to use that, and they're saying, no, we absolutely want straight equity and what's called a priced round, the issue is really a question of what you can convince each other. And what you would start with, if I were in your shoes, is to say, hey, look, I'm changing the world because look at my addressable market, it's so big. And I would advise a bottoms up and a top down approach of saying, if my market is this big, I capture this amount of money, target audience, and then drill down and say, uh, go back to my point of, so you've captured the market, your market, and then you've said, okay, I understand that I'm just an ideation phase, but here are the things I've done to de-risk you, the investor. And it's a question of whether they believe in your ability to execute. Because the point I made earlier, if there are many ideas, but if you can't execute, that idea is worth nothing. But my advice to a lot of the founders is don't be so bogged down with trying to squeeze every last penny, because chances are you'll all be serial entrepreneurs. Chances are, and some of the best entrepreneurs in the world have, you know, paid paid up, and the break that you'll get with and the successes that you'll get under your belt, you can always move on. So don't fixate too much on squeezing every last bit of money out of the investor, because to the point I also made earlier, an investor's in it to make money for their investors. So fair, but essentially either go for a safe, or if you can make an agreement of meeting of minds, then go for talking to them about the market, what you capture, and de-risk by saying, here's how I'll execute, and therefore my value is X.
So, Seema, I'm just taking few live questions which we have received. So,
Sure.
Supriya is asking, how do you find a right investor and what factors we should consider as a startup?
Yeah, to the Supriya, great question, and the point I made earlier. First of all, the most important thing is understand what stage you are in, get a stage appropriate investor. Second, understand whether the investor is investing in your industry. Very relevant. You can't be going to somebody who's investing in, say, solar, and you are doing for fashion, just to be radical. So, know what your audience is, do the homework. Once you find that investor, uh, the ultimate thing is chemistry. It's like a marriage. You want to be able to tolerate each other in the least, and hopefully enjoy each other's company. And then once you figure that you are enjoying each other's company, um, you can see how you can add to their portfolio, and they can add to your portfolio. I can't emphasize enough the need for some level of comfort. Now, you won't ever be totally in love, because at some point initially your interests are very aligned, but recognize that an investor needs to get an exit. And so you need to go in knowing that there is going to be I don't want to keep using the marriage metaphor, but at some point there's going to be a separation, and you want to be mentally prepared for it. um, because that's just the nature of the beast. So knowing those things upfront and while you're entering into a relationship is important, and see if these investors can be counsel and your advocates, because ultimately we tell all our portfolio companies, we will be your biggest cheerleaders, and you can use our name. We'd like to think we have credibility. Use our name as people who've invested in you to gain market access, and that requires some level of chemistry.
So the next question is, how do you value a company that is pre-revenue, but the product is out in the market and being used by the clients?
If it is out there in the market, I mean, to some extent, you if it's being used by customers who are not paying the money, um, and it's really conversion factor, and you're saying uh, it's again convincing the investor of the product market fit that has been established. If I was to be an investor in that scenario, I would like to know the probability definitely of what will excite me is in our case, again, but that's specific to our fund. We are post revenue. So we don't come in at a pre revenue stage. We want to know that that the customer is willing to pay for your service. But that's just the nature of us. So if you are talking to us, talk to me if you're a post revenue company. But if you are pre-revenue and you're still raising money, there are investors out there that'll do that. How do you value your company? I talked about it earlier. Start with the bottoms up and a top down approach, both of saying, here's my market. Here, look, I've even done one step further with the customers actually using it as opposed to it just being an idea in my head. And so getting testimonials from a customer and having a path to saying, I do intend to monetize this at some point. I mean, this whole notion, yes, we understand there was Facebook, yes, we understand there's Google, but look at the amount of the proportion and the success ratios of such companies. Ultimately, I also, I don't want to say it's the greater fool theory, but at some point, investor money does dry up, and hopefully you're catching the wave on its way up, and you have some patient capital. But at the end, you absolutely have to have some revenue. So to recap, if you are pre-revenue, post customer adoption, you're at a better place in life, and you would make a case of saying that look around and see what multiples the other companies have gotten. Well, there is no multiple because you have no. In such cases, you might resort to what is being used as a GMV multiple, which I'm not a big fan of. But or you could do a DCF of saying, I know I have nothing today in terms of revenue, but look at all the captures I've gotten, and at some point, I will be able to essentially be able to deliver this kind of cash flow. So it'll be a combination of both those. The two approaches I talked about of the multiples, market multiples, as well as the DCF analysis.
So, Seema, we have certain raised hands during the session. So I'd request Shreya to please go ahead with your question.
Hi, Seema. It was a great session. So a very basic question, I'm an early stage entrepreneur. Pretty much I've validated the idea with some, basic things. Now I'm trying to establish a product market fit, which is essentially also developing the product a little bit, but I'm not sure if it's a good idea to go and raise funding right now. And I also don't know if people would be interested to fund me at this stage. So, I've been advised by people that I should go and raise like a 30-40 for a PMF, or another option being just bootstrap so that you don't dilute the valuation. My question here being, I personally think if I don't raise it, I might just not sustain so long. And so how could I go about it if I intend to raise funds at this early stage?
Yeah, if you've not even established a product market fit, then you are effectively decreasing the universe of investors. Like I said, we would not be interested. For example, there are investors who are interested in but then your idea has to have some serious legs in terms of being able to convince them of the market that is out there. And and it is you're almost making them buy into your vision at this point of saying, if you give me money, and there are investors who will do that as well. So you just have to focus on finding that set of investors as opposed to a broad brush. So go back and find your investors, to the point I made earlier. With respect to, if you when you find those investors, they'll actually be more hard nosed about saying, show me scale and show me defensibility and show me all the other things I talked about earlier, and how quickly can you move, because I'm coming in, my only way of getting any money out of this investment is for you to raise your next round in a manner that we can then raise the round after that, and maybe the round after that, such that I can get my money out. So you should have a clear plan of saying, okay, this is an idea I have, but once developed, if you're raising outside money share at this stage, you've got to show some serious scalability fairly quickly. And you need to be convincing in your argument of saying there's such a crying need, uh, and people will adopt your product. If you have not even done that homework and you're still unsure whether they'll even be a convert, I would say step back and do a simple consumer test. Like, do a test on whether a consumer, and it could be a simple market research exercise, where you ask a customer saying, hey, have you noticed that you have this pain point? Because half the time, a lot of people don't even notice it, or they may know it and they may not articulate it. So do a simple customer survey and say, would you be willing to pay for something like this? Or, first, do you even want a solution like this? Again, there the caution is not to give your idea away too much, because you don't want to be educating a customer and exciting them to such an extent that they take your idea in. So it's a balancing act. But I would say, in steps, to recap, if you absolutely don't have no understanding of your customer base, the toughest product and the toughest thing is if you're creating a market. And I've lived that life, and I'll tell you, trying to create that market is not easy, because you spend all that time educating people, and then once you actually educated your customer base, you've got to have some serious money behind you to swoop in and capture that audience. um, and so it's a bit of a catch 22, and it's not easy. If it is a problem that you're solving that most customers recognize as a problem, then it's a little more easier, because then chances are, if you do a good job, they'll be willing to pay you for it. So step one, test the market through market research. Step two, find your audience and convince them of the scalability. And then you'll have this intelligence from the customer, right? And you'll be able to say, look, I surveyed 300 people and they all love my product. So why would you not?
Yeah. So I just have a small follow-up question. Since we are trying to develop a D2C brand in health, in wellness sector, do you think it's a good idea to first go with services and curation to prove that TMF, just in case if we are not able to raise something in the next 3 months? I really can't be just sitting around and waiting for raising money, right? I'd rather get moving and show something for the next 3 months.
Absolutely. Look,
Showing
if you have,
traction in terms of using.
sorry, go ahead.
Yeah. No. So please go ahead. I had completed.
Yeah, okay. So, in the D2C, again, if you have the wherewithal, if you have the ability to sustain it on your own, and ask friends and family, I mean, that's the most believable people, because they're not investing in your product, they're investing in your share. So they might say, okay, we don't know whether our idea will fly or not, but we want to support us succeed. So that's the usual set of people. Now, the thing with that is, your goodwill, I mean, other than your immediate family, the goodwill may or may not last for multiple rounds. And you want to set their expectations. Be very, very clear in setting the expectation. Tell them, look, I'm doing it. And while you don't want to over caution them, because then they'll say, what's the point? She herself is not certain whether her business enterprise will work or not. So temper that pitch that you use. But say, this is revolutionary. This is a D2C health space. I'm doing this, here are the things that people will get out of it. And they may also, by the way, in the act of giving you business money, they may give you advice on how to shape that tweak the offering, but or find ways to help you. If you have the ability to move ahead, I would encourage you to just do it, to quote Nike.
Okay. Thank you. Thank you so much.
But you know, the great news, Priya, is yeah.
Sorry, Seema, you were
Well,
saying something.
yeah, I was just going to add, you know, that this whole D2C thing has really taken off in the COVID times. And um, and as a person, I would have never, for example, ever thought of even using shampoos, right? And yet, you know, made for you bespoke shampoos or products like that. I'm actually for the first time looking at it and saying, this might be interesting. So I'm willing to give it a try. And so from a time standpoint, Shreya, depending on what your product or service is, you might actually have a more captive audience because they're all sitting at home, and they're more willing to try new things if you can add some, and that's getting more into marketing. But if you can differentiate yourself with something that grabs their attention and then execute and deliver on the promise you're making to them.
Hmm. Hmm. Right. I'll keep this in mind. Thank you so much.
Sure, sure,
I'll
Seema, we
connect with
have,
you.
sure,
sure.
we'll help you connect that, Shreya. Thanks. So we have one question from Mr. Pradeep. He's asking, how do we find investors in Ayurvedic medicine plantations where the growth is around 20 to 30%?
Yeah, Pradeep. So, in terms of the Ayurvedic space, look, I've looked at that space. There are certain strategic investors, and I kind of glossed over that. You might be able to find some strategic investors. The idea is usually you don't want to get somebody that early who's a strategic, because ultimately then you are beholden to them. Because, for example, if you get a Dabur or a Himalaya in your in on your cap table because you have this most exotic concoction of herbs that the other people don't have, chances are that the other people won't be willing to do business with you. And again, depending on your business model, is it contract manufacturing? Is it, you know, are you creating your own brand? Look, we all know that the ultimate margins on creating your own brand, but that takes a lot of effort. And the Ayurvedic space is extremely crowded. The best place to go find such an investor is somebody who's already operating in um, Swiss you've got to have something very dramatic that you're doing in, I would think, to be going to a traditional VC. I think you'll have a better chance by going to some strategic company that is adjacent to what you're doing. So, for example, you're doing neem products, and then somebody wants to get into neem products but hasn't done it, but is like Imami, or has some products that are not right there but adjacent to it, and they say, we'll just a lot of corporates are beginning to create venture arms specific to their domain because they're seeing it as low cost access to innovation. So I would encourage you to look at companies that are bigger, like sizably bigger, and they don't all have to be in Ayurveda right now. They could be wanting to get into Ayurveda in a manner that can be done through you. And they might say, well, Pradeep can run around creating this company, and we'll make a little investment here, and our investment will be viable because we could essentially either be their customer, their supplier, their distributor, have some sweet deal with you. So I'd encourage you to, given the space, and I've looked at Ayurveda myself many years ago from an investment standpoint, and it's only gotten more crowded. So I'm not dissuading you. I'm just saying find the right investor.
Thanks, Seema, for answering Pradeep's question. Kashid, if you can quickly ask your question to Seema. Kashid, I think you are on mute.
Ruchi, I do have another call, but I'm happy to answer Kashid's question.
I think she's unable to unmute. So we can quickly take one question from Janki.
Yeah.
Janki, can you please ask your question? Janki, are you there?
I think they're all muted. Ruchi, I will have to sign off. Actually, my other call has started today. I was a little back to
Sure.
back.
It was great having you, Seema, and sharing your experience. So there were a couple of questions. How do we reach to AWE funds? So we'll surely help them connect you, and we can pass on these questions to you, and will help you connect with the entrepreneurs who are present on the call as well.
We'd be happy to. Look, we're very happy to help address that. You can write to me, Seema at awefunds.com, or route it through Ruchi, whatever works for you. We are delighted to help you. And stay tuned because we're going to be announcing a big series on the topic. So stay tuned.
Sure. Thank you so
All
much,
right.
Seema, for your time. It was a pleasure
Sure.
having you. Thank you,
Thank
everyone.
you.
Thanks.
Bye bye.
Bye. Bye. Bye. Have a good day.